The U.S. Senate just cast the most important crypto vote in 17 years. And most investors are completely misreading what it means for their money. On May 14, 2026, the Senate Banking Committee passed the Digital Asset Market Clarity Act, 15-9. That is a genuine milestone. But a committee vote is not a law. The bill now faces a 60-vote Senate floor hurdle, then the House, then a presidential signature. Real compliance frameworks won't exist until 2027 at the earliest. What the market priced in on that vote was not certainty. It was probability. Here's the honest math. Best case, bill passes before end of 2026. Probability, 15%. Realistic case, bill passes with modifications in fall 2026 or early 2027. Probability, 60%. Failure, bill stalls. Probability, 25%. The biggest obstacle is the ethics fight. Trump's family has made an estimated $620 million from crypto. Democrats demanded conflict of interest rules. Republicans blocked that amendment 11-13 in committee. 7 Democrats need to flip for this bill to pass the floor. Right now, only 2 are conditionally on board. For Bitcoin, this is largely confirmation of what the market already expected. Bitcoin gets classified as a commodity, outside SEC jurisdiction, under CFTC oversight. That classification unlocks pension funds, sovereign wealth funds, and major bank custody. Price targets for Bitcoin by end 2026. Fundstrat at $250,000, JP Morgan at $170,000, Standard Chartered at $150,000. The halving cycle, ETF momentum, and regulatory clarity are all pointing the same direction. Bitcoin is the lowest risk position in this thesis. Ethereum likely gets commodity status too, but with more uncertainty due to proof-of-stake staking questions. If DeFi developer protections survive the floor vote, Ethereum becomes the infrastructure play, not just an asset, but the settlement layer for institutional DeFi. XRP reacted most immediately, up 7%, because its entire legal future hinges on the commodity versus security question. That makes XRP a binary trade. For most altcoins, the near-term picture is riskier. Exchanges will delist borderline tokens as they prepare for registration requirements. Bearish short-term. Bullish for survivors. 76% of global institutional investors plan to expand digital asset exposure in 2026. Crypto ETF assets under management are expected to surpass $400 billion by year-end. U.S. state pension funds manage $4.5 trillion. Even a 0.5% allocation to Bitcoin is $22 billion in new demand. This capital does not flow in the day the bill passes. It flows after agencies write the rules, which takes 12 to 18 months. The scale adoption happens in 2027 to 2028. Phase 1, now to 6 months. This is the anticipation phase. Markets are pricing roughly 60% probability of passage. Hold Bitcoin. Reduce unclassified altcoin exposure. Keep 20 to 30% cash for opportunities. Phase 2, 6 to 18 months post-passage. Expect a 20 to 40% passage rally. Then consolidation as investors wait for agency rulemaking. Reduce high multiple altcoins on the spike. Add Bitcoin and Ethereum. Phase 3, 2027 and beyond. This is when the institutional thesis becomes real. Pension funds. Sovereign wealth. Bank custody. The $250,000 Bitcoin target and beyond lives here, not in 2026. 4 things could break this thesis. 1. The ethics fight kills the Senate floor vote. 2. A U.S. recession overrides crypto optimism. Crypto is still a risk-on asset. 3. DeFi provisions get weakened in negotiations, removing the innovation catalyst for Ethereum. 4. The 2026 midterm elections swing the House to Democrats who oppose the current bill structure. None of these are certainties. Each is a real probability that should inform how much you hold and how much you keep liquid. The Clarity Act is the most important regulatory development in crypto's history, not because it solves everything immediately, but because it finally starts the clock. The direction is clear. The scale institutional wave lands in 2027 to 2028. Position for that. Stay liquid through the volatility. And don't confuse a committee vote for a done deal. Follow for more.